And with that, we're going to move it on to the next panel, Quants and Crisis Alpha. How have quantitative traders responded to 2020's wild markets? We've got four people who are really deep in this space. Francois Moreau, who's Typhon's head of quantitative trading based out of the UK. Rufus Rankin, who is the grand wizard behind Ampersand investments with a beard to match, but where's the hat, bro? We need a hat. Okay. I'm going to butcher your name, I'm sorry, but Artemisa runs a really novel new quant strategy. I think y'all are going to hear about that. And Vasilis, also a Greek, but I think you're in London right now.
That's right. Yeah.
Yes. So we got the double UK connection from Falcon Money Management. So let me turn it over to Francois, ask you to unmute. Perfect. And kick us off.
Thank you, James. Thanks first to all three participants. What would be great, if you don't mind, is that you briefly introduce yourself and describe in particular the segment of the quant industry in which you are involved.
I can start. My name starts with A. Everybody asks me to start. So, hi, I'm Artemis Woodgate. I've been in the industry for over 15 years now. I was first with Russell Investments as a quantitative researcher. And then I moved to numeric investors about 5 years ago. And in the middle of this year, when the COVID crisis was raging on, I decided to launch my own quant shop together with two other quant expert women. So there were three women running quant, heavy duty. Two of us are from numeric. One of my partners was with numeric for 20 years. And the third one was with Panagora, director of research, director of equities. And then she went to Point 72 as director of risk. So we have a mixture of Panagora, numeric, Point 72, Russell, everything that's based on our experience, but also I think an understanding of having survived multiple crises and seeing them from different angles, seeing them as a manager researcher, as a consultant, looking at how different quants have survived, for example, the 07 crisis, quant meltdown, GFC, then looking at how portfolios misfired, I should say, during the COVID crisis, and then having a really good understanding of what is it that we really want to do and how we want to integrate different quant models. So our shop is called Integrated Quantitative Investments. The integrated part is essential to what we do and how we think, both quant as well as people-wise. And yeah, I look forward to, thanks for inviting me on this panel. I look forward to the conversation.
And Artemisa, you are trading essentially cash equities, is that right?
So yeah, equities, long only at this point. That's where we're launching. We hope to go live January 1st to start a track record. We're self-financed, hoping to stay that way. Hopefully it's going to be it's going to end up being better for our own pockets as well as our clients. But we'll see how things go. But yeah, we're in equities, emerging markets, global, long only at this point.
Perfect. Thank you very much. Rufus, do you want to go ahead?
Sure. My name is Rufus Rankin. I've been investing institutional capital for over 10 years now, primarily focused in the futures space. And excuse me. So we manage multi-strategy and multi-asset portfolios, both on a real money basis, say a portfolio of CTA programs, but also on an overlay basis as well, where people want to add specific diversification or risk management capabilities to a portfolio of equities or a portfolio of fixed income for that, for example. I'm the deputy CIO and co-founder at Ampersand Investment Management. And we allocate to a pretty broad cross-section of different strategies that include strategies that are typically viewed or branded as crisis alpha strategies. Thank you.
Thank you very much. Vasilis?
Thanks, Francois. Hi, everyone. This is Vasilis from Falcon Money Management. Falcon is a fund of hedge fund business. We run around $1 billion. We don't trade directly. Everything we do is through managers. and we invest globally across all strategy groups, but really focusing on market neutral RV and systematic strategies. I'm part of the research team responsible for quant strategies, amongst other things. And within quant, the areas we focus on, I'd say, are, you know, the shorter horizon strategies, predominantly equity, market neutral, and a little bit of futures-based strategies.
Thank you very much, Vasilis. My name is Francois Moreau. I'm head of quant trading for Typhon, and my job is basically to recruit the quantitative PMs we will onboard on our platform, especially the European ones. And our focus so far has been essentially on futures and at a relatively, I would not say, not latency sensitive, but rather intraday to a couple of days of holding period type of player. Then the year 2020 is nearly finished now. Then I would be very interested in if each of you could provide his colors or his perception of whether or not it was a good year for quants, and in particular with regard to performance, right? And also by being very clear on the segment of the industry you are referring to, because I suppose the picture might actually be diverse depending on what we are talking about. Rufus, do you want to start on the futures front?
Sure, absolutely. So March was, you know, good, bad, or indifferent depending on the subcategory or even the particular strategy. It was really a mixed bag, at least as far as the strategies we follow or allocate to. There's healthy dispersion and trend. Didn't see a lot of huge gains or losses in March, and I'm just focusing on March for right now. But shorter term seemed to do better than longer term, in that a lot of the shorter term trend followers came into March either flat or short risky assets, whereas the longer term ones were still kind of carrying their long positions into the month. On the short-term side, some of the short-term managers that we follow had some good performance. Shorter term in the commodity space did pretty well. And it was really the longer-term macro and fundamental managers or programs that had the worst time in March from our perspective. And then finally, the specific strategies we track or allocate to that are designated as crisis alpha programs did very well in March. So they kind of kicked in when they were supposed to, as I like to say.
Thanks. Vasilis?
Yeah, I mean, my comments will be very similar to Rufus. So there's definitely a high level of dispersion observed in performance year to date. But as a whole, I think I mean, if you look at the average or the median of you know, various peer groups, or if you look at you know, the indices or whatever, I mean, the median is zero. Performance is not very promising, and also I'll also highlight that the shorter horizon, you know, stat-arb type strategies did better, both during and around March and on a year-to-date basis. Aside from that, it's hard, at least from my seat, to, you know, pinpoint exactly what distinguishes the you know, the top performers from the you know, the bottom of the group. But yeah, I mean, there's definitely.
You mean that there is no obvious pattern in terms of like the dispersion of performance is not the bad versus the goods, right? It is rather a mix of strategy type and some were more lucky, or.
Yeah, I mean, it's hard to pin it down. The horizon and turnover, definitely that's pretty straightforward, and you would expect shorter horizon strategies to deliver higher Sharpe, right? So that's at least that makes sense. Yeah. But you know, aside from that, I don't know, the dispersion is hard to explain, and it's like the second or third year in a row where we observe this kind of pattern.
I see. Thanks. Artemisa, do you have similar views, or from your cash?
Similar views. I wish I was in my Russell seat right now to have Vasilis' insights. But I don't. I only have, you know, limited insight into what other quants have been doing. But generally, you have it depends on the factors that quant models are playing. So you have some factors that have been, you know, hammered for years now, as Vasilis pointed out, and there's still many quants out there, quant models that have that overly exposed to these factors. You know, valuation, for example, being the obvious one. And generally, I find that there's a lot more interest nowadays in more diverse factors, which is good. Also on the data provider side, you see more data providers that are coming out with alternative data that can be more timely and more informative at different levels, for example, from a macroeconomic perspective. So I love the prior conversation, the prior session where Diego talked about the macro aspect. That's an aspect that I think has been missing in the quant world for quite some time now. And it's a difficult one to incorporate correctly, to really blend the top down and the bottom up. But if you have the correct data, if you have more timely data, that can help. And if you have a way to integrate that information, that can help as well. So that's where I think, you know, you see where the interest has shifted to broaden the horizon and not just look at one, in a single dimension to value equities and to value stocks, but really think about everything else that's going out there. If that makes sense.
Yeah. And do you, maybe that's a hard question for Artemisa, because you, given, as you said, you don't have this sort of, you know, dialogue with as many players as Rufus or Vasilis may have. But Rufus, Vasilis, have you seen some changing practices because it was quite an extraordinary year? Or would you say that somehow the quant have to stick to what they do, and most of them have not really changed the way they are doing things despite extraordinary environment? Rufus, maybe?
Sure. On the quant or systematic side, we've seen very modest changes, if any, which is to be expected, because investors, humans in general, tend to make very long-term decisions based on very short-term experience returns, or to put it more bluntly, you feel bad, so you go change a bunch of things so you stop feeling bad. So that's behavior that we usually don't like to see in systematic managers. That is large wholesale changes to the program. So the changes that we have observed, if any, are quite small to marginal, which is more along the lines of what we'd expect. We have seen more, I guess, changes in terms of what the smaller complement of discretionary strategies we work with have done, but on the large, for the most part, there haven't been many changes. I think you kind of, you know, take in the new data and see if it is significant enough to drive any particular changes. But most of the strategies, or the quant strategies we allocate to, will adapt to that as they're reading the tape, so to speak. They will adapt to that in real or close to real time. So there's not a great need to make a significant change at the program level for most of the people that we track or allocate to.
And would you say that it's also true for risk management in March, when, you know, the events were quite extreme, and even some normalized or like adaptive system could be pushed a bit, to their boundaries?
Yeah, I think it's really hard to solve for, what was it, the 13th and 16th of March, especially that Monday, which I think was the 16th, when everything was down double digits, because, your usual diversifiers were also down as well. It wasn't just equities. It was precious metals, it was fixed income as well. So I personally don't have a clear view on what the right solution to deal with those problems is. And we haven't seen like real big changes at the risk management level. They've been mostly incremental.
Okay, and in line with what, with the long-term stance and, no aggressive cutting of risk or whatever.
Well, no, the size has changed a lot. The position size has changed a lot. I'm sorry, I was referring to how the program evaluates the risk in markets and what they do as a result of that.
My point. Yes, obviously, I totally agree with you. But my point was the methodology remain in its integrity, right? That's what you said.
Yes, and some people have begun or have been working on research projects to attempt to deal with or answer the problem of these very rapid sell-offs in multiple asset classes that happen all at the same time. And we haven't seen like a definitive answer, oh, this is the way to deal with it. But we have seen a few ideas coming out that we hope will develop well.
Yeah, it's not a trivial problem to solve from a quant standpoint, I suppose. Like the number
Certainly
of
not.
And it is relatively challenging. Vasilis, on your side, how would you describe the, how to say that, the whether or not managers have changed their way of doing things, if they have kept, stick to their methodology?
Yeah, I mean, more or less sticking to their methodology. I mean, I think it's always about, small incremental changes. And most programs are, designed to adapt or, anyway, right? Or to identify the regime and adjust accordingly. So nothing huge. Obviously, in March, some people intervened to cut risk, and we know what happened. But I also heard anecdotally some managers in March, they dug up models, deep in their libraries that they hadn't used for many years, that work well in this type of environment. So, that's maybe a positive, as opposed to what Rufus touched on, which is quants usually, when they make big changes, is for negative reasons.
Maybe I can just add one thing here. For the last, I guess, since the quant crisis, literally the concept of crowding has become very important, and I think a lot more quants are realizing that the crowding into the same signals basically impacts how their portfolios can adapt and how they can react to different market events. Now there's the economic crisis, or things that are not necessarily crowding related, and there's pure crowding events, but they also overlap. So when you have huge drawdowns, when you have huge market moves, you can, if you're in the crowded trade, you get a little bit more of the medicine than you need. And so that's kind of maybe one of the areas where it's more of a glacial change. Hopefully, nobody's gonna flip switches and move portfolios willy-nilly or change processes willy-nilly, but the focus on crowding, I think, will continue, and I've seen that basically at prior shops and then across the industry in terms of the talk. So maybe that will be along the lines of the regime or what has changed, more of an understanding of where you are with respect to the market participants that can maybe help. So I'm not sure, Vasilis, if those are some of the crowding models, if those are what people dug out of their closets, but that's just something that I tend to be aware of.
Yeah. I mean, yeah, and I think optimizing yourself based on the last crisis or the last drawdown is generally not a good idea, right? It's an overreaction.
Yeah, that's where Rufus would fire them, right?
I prefer the term deallocate to firing.
Okay. Great.
Because we could reallocate.
Yeah.
But yeah, you feel good for a few months or another year, and then you're just completely wrong then at some point in the future. So that is a big thing, a behavior to avoid.
What would be the thing you would have learned from the year that has gone with regard to quantitative trading? Is there one thing that the year has brought as an insight? Vasilis, do you want to take this one?
Okay, that's a tough one. That's a tough
and
one.
the answer may be no, right?
I mean, the answer is a bit sad in a way, because you see the market rewards doubling down and buying the dip, and we saw that even with Quants mid-March, as I mentioned. So that's a bit sad, because it's challenging for relative value trading oriented strategies. And yeah, I mean, to have staying power in your positions and in your strategy, and to be able to survive to fight another day, you need to be very deliberate with your risk management and make sure you're not running at maximum risk on a steady state, and your cruising speed is basically somewhat below, which will put you in a position of strength in periods like March. But that sounds good, theoretically.
In practice, it's
yeah, in practice, it's a different story. Yeah.
Artemisa, any view?
Well, given that we're building our model now and hoping to get a good model, but not one that would have performed wonderfully in March and not other periods, right? Because that's the danger. We haven't, we're not even looking at the year when we're designing our model. That's completely out of sample, basically. But the thing that has been kind of hammering home for me personally, comparing this crisis with the other crises that have happened, is really the importance of having multidimensional information that feeds into the model. Really having an understanding of what are the different drivers at the industry level, at the country level, from a macro perspective, currency perspective, everything that can feed into that is important information. So you don't just throw away, and are oblivious to what the market is telling you, but can incorporate it in a model in a balanced way. We have a saying, my co-CIO has the saying, says, let the data speak, let the statistics decide, let us manage. So let's let the data speak, let the statistics decide, constructing robust models that can deal with different information, and let us manage in terms of understanding the market positioning, what the model might be missing, and how to manage the portfolio positions explicitly and the factor exposures. So combining these three things, but really from a multidimensional perspective, is really what I think is important. One of the key things, though, is to understand what is noise versus information. And I know you sent around a question in the prep around, is it just a outlier? Is March an outlier that's from a quant perspective you just trim and throw away? or is it signaling a new regime, or what is it? And that's the bit that I find that many quants, I guess, are struggling with, in that outliers are treated, you trim them, you Windsorrize them, you mix different data sets to just create this blend. But quite often outliers are there because you're asking the wrong question. So, I have an example I used in the past where if you look at, for example, Google Trends and you search flight tickets, and you look at the demand for flight tickets or airline tickets, and you see that, oh, the demand spikes in March when nobody travels. Well, that's an outlier. Let's trim it, Windsorize it, get rid of it, blend it with other, or throw away the whole data set. It's not important anymore. But if you ask the question, airline tickets cancellations or airline tickets refunds, that's where the spike is, not airline ticket purchases. So that's where, really understanding what question you ask, because everything that you bake into a model is an answer to a research question that you pose. So an outlier might be an outlier because you asked the wrong question. If you believe that the question is what's demand for travel, but you misstated that question, the data is going to give you an answer. And then you say, oh, it's an outlier, the data's bad, throw it away. There's a regime change, something happened, no, it doesn't matter anymore. But really, in fact, the problem is you're asking the wrong question. So that's kind of, that's for me what frames our thinking around how to model and how to incorporate different information, to really think about what is it that you're asking and what is it that the data is telling you.
Thank you, Artemisa. Rufus, do you have any takeaway?
Yeah, I really wholeheartedly agree with Artemisa's point about asking good questions. I recall my advisor years ago just said basically all of research is asking good questions. And he really hammered that into me. His name was also Francois, incidentally. So one question I think we always have to ask is, am I good, if we're doing well? Am I bad if we're doing poorly? Or is this luck? And it's very, very difficult to disentangle skill from luck. And a lot of papers have been written on this. But if you break down the pieces of your process and ask, is this premise, is diversification still a good thing, or should I be focused on a sub-strategy? Is my risk weighting approach valid or not? So I think it's important to ask good questions that are clear and answerable, and then come up with reasonable ways to attempt to answer them or validate what your beliefs are. So I've always been a fan of simulation, and this year I've done a lot of simulation around pieces of our investment process to see which are valid and which results that I have liked or not liked were more likely luck versus good or bad decisions that we made on our part. So asking good questions, asking clear questions that you can actually answer, hopefully somewhat objectively, and then coming up with a good approach to answering them has always been important, but I think this year has really emphasized the importance of that. And simulation, just as a tool from where I sit, has been helpful in doing that.
And not getting too overexcited by short-term recent information, right?
Right.
James,
I love what...
A bit of time, or? Okay, then maybe a final question is, do you expect 2020 to give any indication of the future? I know that past performance is not whatever, but like, do you think that what some of the things we have seen in 2020 will rehappen?
There'll be another crisis around the corner. Yeah, I mean, the world doesn't stop. Again, going back to the prior presentation by Diego, are we in a bubble now? What's the next shoe to drop? Is it a currency, a renminbi devaluation? How is that going to impact the markets? Is another trade war. There's just so many things that happen around the corner. And I just want to emphasize what Rufus said, that is so true with luck versus, skill. And, to extend what you said, Rufus, if you don't know if you have skill or luck, are you exposed to that risk, or do you have it hedged in some way, right? If you don't know that you can time inflation, or you can read inflation, do you take a bet on inflation implicitly, or are you neutral? Do you find a way to neutralize that risk, just because you might have been lucky, but you don't really have skill in that area? So yeah, with the next crisis, I really don't think you can go around crises. And I think if you just design your models for fair weather, good luck. But that's my view. That's our view.
Vasilis?
Yeah, agreed. I mean, these things happen, right? If you zoom out enough, there are no outliers, and the market will find the exact sequence of events that will cause the most pain to your portfolio, and then really put you to the test. So in terms of the quant industry, I mean, absent any big structural changes, I'm curious to see if there's going to be substantial flows in or out. I think that's the only thing that might change the dynamics near term. There's definitely areas that are probably, oversaturated. I don't think we've seen anything
Charles,
big.
Can you be more specific on that one?
I mean, the more commoditized alphas, either risk premia type alphas, using the term loosely, and that's actually the one area where I think we've seen some outflows, and it remains to be seen, what this means for the survivors in that space. Yeah, but I think, I mean, I think in most areas there's more, there's just more demand than there is supply.
Rufus, your view on the future, and whether or not last year can give any indication of what's next?
I think last year was instructive in more in behavioral terms than, here's how you adjust your model to account for how crises will go down in the future. And that is really, I think every investor should always be conscious of analyzing their behavior and how that drives, how their emotions drive their decisions. So I think that's key. And I think we've had kind of a very short period or window in which we can do a lot of self-reflection in that fashion. I don't think it's instructive in terms of how future crises will happen. I agree with the other panelists there. I think it could come from anywhere. But it does suggest that to the extent you're using quantitative methods to manage your portfolio or your trades, I think this is a good reminder that we should take whatever we thought the worst case scenario was, doing kind of stress testing, if you will, and make it worse. Because I do believe that this was the fastest and largest equity drawdown in history. And who knows if the next one will be as fast or even faster. And who knows if other assets that historically people have bought as equities were going down will be helpful. So it's instructive that everything can go down together. Once again, it isn't the only time, but everything can go down at the same time. So I think this really should be an impetus to quants to reevaluate their approach to stress testing and come up with a much bleaker worst case scenario.
Which is not always easy to backtest, right? Because
it's not.
That's where the quant may have some limitation. If you have some liquidity event and stuff like it's quite hard to model those things.
Yeah, you have to kind of, I think you have to go outside of the data and try and make up scenarios, frankly, rather than using historical scenarios are one piece, but I think you just have to imagine your own scenarios as well.
Yeah. Which is probably out of the usual comfort zone, I suppose.
Mm-hmm.
Yeah, great, guys. We're going to take one more question here. So from the audience, the question asker asks, he understands that there is no precise answer, but do you think there are more quants that are just running statistics-based strategies than are quants who are focused on the market microstructure? The rotation that took place in October and November, which affected many quant funds, can be a confirmation that many strategies are actually stats-based, like trend following.
Yeah, I think a lot of the assets allocated are to what I'm interpreting, if I'm hearing that question right, what I would also interpret as statistics-based rather than market microstructure-based strategies. So that's an interesting observation. Not all the strategies we allocate to fit that description of being statistics-based, but I do think in general, most of the allocation dollars or AUM are allocated to strategies of that first category rather than the second. It's an astute question. Thank you.
Yeah, I would expect.
Add on that? Sorry.
No, I would expect the capacity of the two space to be completely different. And when you look at a sort of volume weighted, they are not comparable in impact, I think.